Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is July 4th edition of Market Outlook in the year of 2016. So quite a wild week we had with the Brexit, the Monday morning sell-off, and the Tuesday rebound for the rest of the week, which brought us back up over 3% for the week and about where we started last Thursday as of the close. So let's take a look at some of the market internals and overall what the technical picture is. And again, with this week's up move, as we can see, of 3% pretty much across the board in all key indices, puts us up mostly about 3% for the year as well. So yearly gains made after the recovery and the bounce starting this week. Now, last week I had covered and had mentioned that we looked pretty oversold, looking at some of the sentiment indicators. We were looking for a little bit of follow through on Monday and possibly Tuesday. We got exactly what we had been looking for. Now, a couple things to focus. Look, in terms of accumulation versus distribution days, the only thing you can say is NASDAQ definitely moved up nicely this week and actually now has more accumulation days. That's been a pretty big improvement overall in the NASDAQ 100. And again, looking at the accumulation versus distribution, we're pretty much even. So not much can be said right now about volume, except that NASDAQ 100 looking a bit better based on the accumulation versus distribution days. And again, accumulation day is when you have an up day on greater volume than the prior day. That's what qualifies as an accumulation day. And the inverse is true. So there you can see 3 days accumulation, 1 distribution. That is a definite improvement in NASDAQ. All right, let's go to some other charts here. Now, there's a lot of things that are setting up that is concerning about the overall health of the market. Let's take a look. As you can see, look, utilities still continue to roar. The 5-day up 3.7%. If you look at it relative to virtually all of the other sectors, it was definitely doing quite well and leading. So net utilities, the safe play, still in number 1 position. Position number 3 happens to be real estate. Now this is IYR. So these are REITs. So that is also a yield type of play. This is not speculative real estate or home building. This is real estate trust, which basically is an income type play. The other thing that is concerning as the market makes new highs, consumer staples is in, again, top position. So the speculative sectors not doing quite as well. Semis up, right, 2.7% for the week, underperforming the overall market and falling in position. So again, more conservative plays doing quite well, and that is definitely a sign of caution, even as the market makes new highs. But nonetheless, the market is continuing its trend up. I'm going to get into a couple of other charts that look interesting as well and may shed some light on where we are. All right, so now let's take a look at market hotspots, because this also now starts telling a more complete picture as to what's happening in the markets. So first thing to notice, wow, look at this. Silver, gold miners, oil, metals and metal mining, and even natural gas all up sharply. In fact, some of these were up over 10% of the week And of course, these have been holdings in several of our trading models. So let's take a look at what has been lagging. And that also helps shed a light on what's going on here as well. So look, lagging, 6-month laggers continues to be IBB. Also interesting, in terms of countries, Italy, Spain, these are things that are deeply in trouble. Did we get a really nice rally? Yes, off the lows, but Italy, Spain, a lot of the countries in the EU in trouble. And look at the country that's leading, Brazil. Why? Big in commodities. So definitely move into commodities, looks extremely strong. 5-day change in silver, up 10%. This feels like being on the old days on the floors in the late 70s, early 80s, when the hunts were involved in the corner of the market. Silver just roaring. The 1-day action up over 5% on Friday alone. Gold miners not far behind. And then, of course, other commodities picking up the rear. So interesting, really good moves today in commodities. This, you can't mistake, no question, it's commodities. And losers, banks. Interesting. So, listen, longer term, sometimes it takes a while for these tops to play out. Could we get another rally off these levels in the stock indices? Absolutely. But commodities moving up relative to stocks in a really sharp way, as you're seeing in here, does not pretend well for the longer term, because the central banks will eventually have to raise rates, which squashes rallies in equities markets. Okay, so now let's take a look at where some of the internals are. And let's take a look at up-down volume. As you can see, up-down volume crossed the midpoint here. Let me get the pen and highlight what I'm seeing. So this is the midpoint. We cross back over. It's a bit more of a positive. Again, the McClellan oscillator, which is really a good intermediate term, right? Looking out 30 days. The top indicator is good for a week or two, sometimes a little bit more. But the McClellan really looks at a time periods going out well over a month or more, sometimes two. But the point is that we got oversold and have had a nice bounce and crossed above the 50 line. Now, we have hit the level where we sold off from just about a month ago. So we want to definitely be cautious and make sure that we continue to get even stronger, and that's a better sign. So I would like to see the market continue like here as the market moved up in order to confirm a potential move. So overall, again, definitely with this rally, this is in more positive condition, which is the up-down volume. The McClellan oscillator, which looks at advances, declines out over a longer term period, also in gear. And shorter term advanced declines here. We definitely crossed over the midpoint, now getting rich. But again, until we cross and start turning down and getting beneath this key level here, which is that blue line, we're in gear and positive. So certainly got plenty more room to the upside. Looking at these indicators, it's definitely in a positive position overall. So market health not running, or market internals not running ahead of itself at this point. Let's look at the same picture for NASDAQ. And we virtually have a duplicate, but not quite as strong. Let's take a look at and see what I'm talking about in NASDAQ here. As you can see on advance declines, NASDAQ is not doing nearly as well as the S&P, right? You can see we did cross the midpoint after being oversold here, right? Especially as we sold off here, and we've now turned back up. That is definitely, this part, definitely more of a positive and more room to work. But again, sort of lagging the S&P. So although we have more room to the upside, and this is positive, again, NASDAQ still quite a bit weaker than the S&P. Now, one good sign, we definitely got oversold on the sell-off. And look, we've now bounced up, crossed above the midpoint. This is definitely in gear as well. Now, up-down volume, even though we had accumulation days on an absolute level, just now starting to get a little traction, moving above the 50% or the midpoint. So that's a bit more of a positive. Okay, so market internals looking definitely helpful to the market. Now, let's see what else in terms of market indicators. In terms of new highs, new lows, you can't really argue with the S&P 500. No sign of stress here at all. In fact, if anything, you can see we move back against the upper boundary here, which is a positive sign unless you really get under the 70% level. Anything above here is considered positive, and especially oversold levels. Of course, if you go from over here to above this blue line here, which is 70%, 30%, or even the 20%, that's the beginning of a buy signal. So a beginning of a sell signal would really be a drop now beneath this 70% level for now. And again, from a technical standpoint, right, we basically crossed back over the 200-day moving average. We're now above the 50-day moving average as well. So within just a couple of days, we changed several phases to the upside. So again, as long as we hold here the levels that were penetrated with these moving averages, which come in just a couple of points lower from here, somewhere around 207, 206 level, I'd be a little bit concerned. So you got some room for movement here. 1.5 to 2% on the downside would be expected and still not threaten the overall bigger trend that now has been put in place to positive. Okay, so interesting there. Let's take a look at our next chart, which is the Qs. And Qs, again, with the new high, new low, definitely not as strong. In fact, I would say unless we can get a little bit more convincingly above this midpoint, NASDAQ and where it stopped right now, right around the 200, is definitely weaker on this one. So I would give the new high, new low ratios between the two key indices sort of a neutral. All right, let's go to the next chart. This is the volatility. We're looking at VIX, and as you can see, one of my concerns last week was that we were running with this massive sell-off overnight. I mean, that was a pretty sizable drop, was definitely getting frothy. As we hit the upper end of the Bollinger Band, I was concerned that the volatility was really not going to yield much more to the downside. We had anticipated a Monday morning lower opening, possibly even on Tuesday, but all we got was Monday, and then it was the cover. And if you were short, a good point to cover or an opportunity to get long, certainly against the 200-day moving average. So right now, volatility back into normal range. And so the panic is over. Not much to be said from here. We're basically in its normal trading range, back into the Bollinger Bands that look like they're contracting, and back even under the 50 and the 200-day moving average, which means markets have certainly settled down looking at VIX. Now, we also look at VIX in another way, which is looking at short-term versus long-term volatility. Let's go to the next chart here. And again, this was another chart that told us that there was quite a bit of frothiness or excessive pessimism last week on the close on Friday. And in fact, we did get what we expected. And we said potentially maybe a little bit more down once we cross back over, which basically occurred right on Tuesday. We got this really nice size rally. So at this point, you got plenty more to the upside in terms of where the volatility comparison or ratio here can get to. So everything looks in gear, flushed on the downside, reversing, and things trending in gear. So from a volatility perspective, it looks like the storm has passed and volatility is back into normal range, which is positive for the market. Now, a couple things that, again, looking at a little bit longer term, look at this. This is a chart of Brazil, right? EWZ. And you can see Brazil is on its own trajectory, right? It actually ended up making new highs. And again, if you compare this against our real motion indicators, we're really moving out to levels we have not seen in quite some time, in years. So this is some of the best momentum that Brazil has had in quite some time. And again, we're just really getting going. You can almost say this is sort of a, let's put a trend line or what we can ascertain here. So you can almost say like this is a shoulder, maybe this is a shoulder, so it's sort of a crooked head and shoulders type bottom, and we take this to our neckline. We're talking 18 to 28, about 10 points. We could possibly get another 7 or 8 point rally, which is really nice off of this. Now, let's take a look at gold. And again, gold looking just ballistic. In gear, we've been really bullish on this one. And again, you can see just how momentum shifted way early here in our real motion indicators, and our price performance versus the S&P. You can see longer term, we turned up at the beginning of 2016, right? Once this blue line crossed over that black, that's a longer term moving average. And again, you've just been in gear. You've had some periods of consolidation and retracement, but overall, you can see that against our benchmark S&P, gold is extremely strong. One last thing, silver. Look at this. This has gone completely ballistic. And again, huge volume down here. That's very positive. And at the same time, you got a situation where relative to stocks, let's take a look at this chart here. This is our ratio chart here. And you can see that silver has just been in gear since the beginning of April. And even with the sell-off, we never lost real momentum against the S&P. And again, just ballistic to the upside. Under these scenarios, you definitely want to watch some short-term trading patterns to see if you have a blow-off. But with the central banks in problems here, not able to really raise rates, it looks inflationary. And again, the relationship between commodities under this type of scenario does not play out well for stocks longer term. Now, that does not mean over the next 2 to 3 months you can form a top and stocks could still move higher. But let's be prepared and know and keep our eyes forward and understand also what history portends as well. All right, that's it for now. Hope that helps. See you next week. Stay frosty. Oh, before I go, there's one other thing I want to take a look at, and that is this. Okay, this is our real motion indicator. This is a really excellent chart. It's long-term in nature, right? This is looking at weeks, right? This is a weekly chart. This particular chart here, 200 weeks. Look how this 50-week is starting to converge on the 200. Now, in terms of our real motion indicators that really measures momentum well, look what happened. Once we hit this blue line, which is our shorter term moving average of the weeklies, we stopped here. So when I say longer term, we're at an inflection point. If we get much higher from here, I wouldn't be surprised to see another move potentially back up to this green line, which could put us up 7 to 10% higher. On the other hand, if this, right, and look what we did. We reacted, right, on Friday. We were clearly rejecting the price levels once we hit the upper end of this moving average of our momentum. Now, we're here right now. So we're at sort of an inflection point. Now, that doesn't mean it can't move around just around, the resistance level, which is a little bit higher. So we really want to watch this chart as well. So stay tuned, and I'll keep you informed as to what's happening with the longer term momentum. So it's interesting, right? Momentum, we held that 50-week moving average on a closing basis. And even though we opened up beneath it, right, that was the opening, had a little flush and came right back up. So it'll be interesting to see how exactly this operates around these levels in here. Okay, have a great weekend. It's July 4th. Enjoy yourself, take a break, and come back fresh on Tuesday. See you next week.